Good morning. It's Jeffrey Cohen, February 10, here to talk to you today about the Consumer Price Index 2021. So it came out that the prices have gone up 7.5%. So very, very important. That's the fastest rise in a really long time. So why do we care about it? Because the average American that has to buy groceries or fill their truck up with gas, right? I got a son. He's got a big vehicle, a V8, big engine, and he gets 10 miles a gallon, and it costs him almost $4 a gallon now in Chicago to fill up. So CPI up 0.6% in January. All items are up 7.5%. So what's the insight, Jeff? What do we care, right? Well, first thing is 7.5%. So if you think about it, put it in perspective, our economy is $20 trillion, give or take a few trillion. This means prices went up 7.5% times $20 trillion. That's $1.5 trillion of inflation. So it destroys a lot of value. Just to put it in perspective, energy prices, I still talk about it. Overall up 27%, but when you look at things that people use, gasoline's up 40% this year. Energy, electricity, we heat our home with electricity. You can kind of hear it. It's 11%. Used cars and trucks, still up 40%. Now, if you wouldn't have put your money in the stock market and you would have put your money into used vehicles, you would have made a ton of money. I was going to show you, maybe it's worth it. The last run of the model, it's fine. Basically, the Russell's down 10%, the S&P 500's up less than 20%, Nasdaq's up 10%. So you'd have made 3 times more money if you would have just bought a used car than bought some stocks. But the things that are more normal, things like services, they're only up 4%. So this is an economy where stuff and energy is more expensive. And I think energy permeates through the whole system. A year ago, I thought this wouldn't be a big deal. I thought that our president would realize that gasoline is really important and would open up the pipelines. Remember the XL pipeline? First thing President Biden did was cancel it. The state of Michigan shut down a pipeline with Canada. This is horrible, right? We need to be drilling, piping, and selling to other countries all this energy and making a profit for our country, as opposed to letting the rest of the world make money on energy. That's my political statement. I'm really sorry, but just consumer price index, really serious. So the energy index overall is up 27% over the past 12 months. This is horrible. So let me go back to, there's maybe like a pretty picture or something about it. Oh, there's real earnings that are out. This is the other thing that's important. Real earnings. So this is the money that people make after accounting for inflation. So when they say real, that's different than nominal. So nominal is just what you see in your paycheck. Real is they subtract out inflation. So real wages increased 0.1%. That's good. At least people making a little bit more. Oh, this is not good. Real earnings decreased, went down 1.7% over the year. And so, why? Jeffrey, why are people bringing home less money in their paycheck, which hurts retail, which hurts standard of living, which hurts a lot of things, which hurts people getting out of poverty? Average hourly earnings are down, and there's a decrease in the average work week. So the average work week went down 1.4%. So you make 1.7% less when you work an hour. People are working 1.4% less hours. Actually, the average American is 3.1% poorer than they were a year ago assuming they have a job. If you don't have a job, you're 100% poor. So in terms of wages, so this is important. So you combine high inflation with a shorter work week and not a lot of raises, and this is what happened. So, I mean, we had a hypothesis this would happen. So what did it do to the market? And Jeff, what's this paper trade? So part 2 of the video, Jeffrey Cohen made 3 paper trades. One of them, which I published on Twitter, was PHUN Funware. So it had to be a paper trade because Funware, unfortunately, you can't borrow it, right? And so we were going to make the trade last night, 5 minutes before market close. So let's do a 5-minute chart. We were going to do it right here at 350. So CPI came out and the thing dropped to 340, 330, 335. So we were going to buy 5 minutes for close, sell, cover 5 minutes after open, make, I want to say it was like 10 cents a share, 100 shares, 10 cents. It's nice, good money. The other one was Soluna Holdings. They make data centers, and they're starting to use them for Bitcoin. Same thing here. 5 minutes before, 5 minutes after. So what happened was 5 minutes before market closed, the thing was trading at 965. I had written down 961 because there was a 8-cent spread at that point. So you could sell at 961, you can buy at 969, 8-cent spread. So figure we got it at 961 because we're hitting the bid. And then right now you would sell it at 956. It's fine, but this actually was down. Also, you can see quite a few pennies there at the open. We figured we could have made about 15, 20 cents a share on that one. LWLG, Lightwave Logic. Same thing. So, just to go through it. So 5 cents before, 5 minutes before, it was at 757. I was going to do it at 759. I would have been executed. And then 5 minutes into the trading day, there was a time when I could have gotten it down about 5 or 10 cents. So what's interesting is, because I knew CPI comes out, boom, you're going to hit the, you're going to hit it. It's going to be great. But now take a look. So if you would have held those shorts long, okay, you'd be down 35 cents, 40 cents on Lightwave. Soluna, you'd be about even. And Funware, you'd be down about 13 cents. So 5 minutes in, 5 minutes out with a short, they have an expression, you sweat in the service of your shorts. What's true? So, a 5 minute in, 5 minute out around the trading day close, that's terrific, right? That's a good trade. But this would have been a bad trade had you have held on to it too long. And so I'm learning something. When I buy, most of my stocks I'm thinking like 3 months, 6 months to hold it, right? I put my money in, I try to forget about it. I buy value, I buy a good deal. And what I realize is if you're going to trade around things like the CPI reading, and let's be honest, I knew that the number was going to be high. It's a 40-year high. I knew it would be high because the prices that we're paying at the grocery store have gone up. Do you know we actually went to a cheaper grocery store and their prices were up even more than the regular grocery store? And the reason is that they're part of a cooperative, and so when things go wrong, a cooperative doesn't have guaranteed volume purchase agreements, and so they get hurt even more than let's say a grocery store that's owned by a big chain and they've got purchasing commitments and contracts as opposed to just voluntary cooperation. So next thing I want to talk about, American Shared Hospital Services. Disclaimer, we are long American Shared Hospital Services. We love this stock. We love this company. This is a low float runner. This thing's going to make us a fortune. I'm going to be able to get my car painted and probably even fix the bumper with the profits I'm going to make on this stock. American Shared Hospital Services. So that's my disclaimer. Now let me talk about what happened. So nothing ever happens with American Shared Hospital Services. It's sleepy. It's a very sleepy company. It's a very sleepy stock. Look, it traded 78 shares this morning. Are you kidding me? 78 shares. Okay, fine. So let me get into the details now. You know what? Let's take a look at the chart real quick. I want to show you some due diligence on it. So you got to look at like a weekly chart with this stock because it just doesn't move like at all. So where's the closing high? That kind of the average closing high, probably here. So you're at like the $3 range. An average closing low I see 216. So you got a pretty nice range there, and it's been moving up, down, up. It popped over, under, down. So the stock moves. Let's go back in time. Let's see if this range holds. Yeah, I mean, I wouldn't make the low quite so aggressive. Maybe we bring it like here. But still, this thing's got a trading range. And so if you're okay with a trading range, kind of a bold trading range, you could probably move. You could probably see this thing moving. So what's going to happen is it's down. It's probably going to bounce up. But you know what? It could bounce up after it hits $1, for all I know. But I like the stock. So we're doing due diligence. Nothing ever happens. Mevion. So you see this big device here? It is a pencil beam proton therapy system. So what happens is you get cancer in your brain. Now, God help us, we don't. None of us do. In your heart, in your spine, in your lungs, anywhere where it's really sensitive. You don't want to be digging in there with a knife, getting into your spine. You're going to break it, right? Or your heart. That's awful. And then the normal way they do it is they shoot x-rays into your body. They shoot radiation treatments, right? And the problem is if it's in your spine or your heart or your brain, if you're not very accurate, you kill a lot of healthy brain cells or heart cells or spine cells, right? The cure hurts. With this case, you can model exactly where the cancerous cells are, and you could be very precise. No cutting into the person, very precise treatment. It's not quite outplacement, but it's kind of like outplacement. You just get in, you get out, you kill the bad stuff, you wrap it up. I wish this was useful for my portfolios. Just get in, get out, right? So the good news is that yesterday, Mevion Medical Systems and Proton International announced that they're bringing a new device into San Antonio, Texas. There's a therapy and research center. So this is great. So why do I care about that? Well, it's nice. University of Texas. It's good. People are going to be helped. Children's Cancer Research Institute. You're going to help with the kids. But why I like it is that American Shared Hospital Services has a contract to buy 2 of these and to install them at a client. And they've guaranteed a price of $34 million for the 2 devices. Now, inflation's 7.5%. They just made $2 million on inflation. They made the deposit back, right? So I'm loving this now, right? Go place some units. They have to be these Mevions. The exact unit that they contracted for, the S250i proton therapy system, is the one that they got to sell. The good news is someone just bought one. So what that tells me is there's hope. There's hope that American Shared Hospital Services will be able to sell or open up their own clinic, you know, take an equity stake in someone else's clinic, but for this device, and start providing these services. And when AMS does that, they make good money because they lease, they finance, they install, they buy all the services, and they offer their services on a per-use basis. So it's not just, I'll sell you $1 for $1.09 like at ComDisco, but this is more, I'll sell you the services. So that's great. So what I wanted to talk about last, topic 4. So the consumer price index came out, and you would think Hey Jeff, everyone knew inflation was coming, right? But let's take a look at the S&P 500 and see what this read really did to the market. I'm just going to be simple here. I'm going to use this screen. Just so simple, right? 5 days. So if you look at Thursday, there's market close right there. So at market open, the market dropped. It dropped 17 points. Call it 4%. 0.4%. So it dropped. It's something. But then it went back up. By 10 o'clock, the market had said, it's no big deal. 7.5% inflation may be bad for Main Street. It's not so bad for Wall Street. Well, this is interesting because if you were waiting for a big move, you weren't going to get it. So I knew the read would be bad. I knew the immediate knee-jerk would be bad. But then the market kind of came back. And so this bouncing back is actually a sign of good liquidity in the market. What is interesting is how the volume continued to decline. So the volume was very high into the close. This is when we did our paper trade where we were going to short the 3 stocks. But come the open, actually the opening volume is higher than on the other days. So good volume today, good liquidity. The people came out of the woodwork today with fresh money. I think that's something you want to think about. So liquidity's up. But let's look at where that liquidity is being placed. This is a watch list of just a whole bunch of stocks that I watch. Some of these are, affectionately I call them shitcos, but actually they're small cap, no profit, just bets on the future. Some of these are really big retail type companies like Alibaba, Walmart. Some of them are Amazon. Some of them are consumer product companies like Kimberly-Clark, Verizon. I got a whole slew of stocks in here that I look at. Some of them are long, some of them are shorts. Some of them are pot stocks, some of them are Bitcoins. So let's take a look. So when I first opened this up at like 8:40, 8:35, 8:40, it was all red. Now there's plenty of green in there. So what this tells me is, and by the way, there's your Bitcoin stocks, Mara and Riot. Here's your pot stocks. Here's a pharma. Here's a Bitcoin. Here's pot stocks. I mean, things are up. What this tells me is retail's back. Or investment managers, wealth managers, hedge funds, the algos are back and saying, you know what? Today is not the day when we're going to take down the market. Today is the day we're going to bring the market back up. And so I look at this and I wonder to myself, it's a risk-on market. Everything in me says that the market should be falling right now, but it's not. In fact, market looks good. I mean, certain stocks are down, right? It's hard to know. I mean, there's just individual stories. But this is interesting. So your highly liquid stocks are down. Walmart, Google, Amazon, Kimberly-Clark, Verizon, those are down. You see what's up? Telray, Satsuma, Riot, Silver Lake Capital. So if we look at this by market cap, because that's always a good way to look at it, the small caps looking pretty green. The large caps looking very red. So in a way, this could be sell the highly liquid stocks, raise some money, because let's be honest, inflation's going to come and it's going to hurt stocks. And we could pump a little bit into the small caps. This tells me maybe this is retail driven. And so you heard it here first. So I want to thank you guys for listening. I really appreciate it. I didn't get any questions in the chat, but just so you know, I watched the chat. And if you had any, I would have answered your questions. I'm going to say wrapping up. AMA, question mark. Can ask me anything. So again, thank you very much. I appreciate your time. Just leave you with a visual as we go for the day. This is the FinViz S&P 500. This is the full set of stocks that they track. This is today's market. Today's market is red on the largest stocks. So this, I believe, is sell your highly liquid stocks, get the money that you can, but money's being pumped into some growth stocks. So it almost feels like a little bit of a head fake here. So, all right, you take